Good morning, and thank you all for joining. Today we have a very good webinar for you all, which is really about how to position your investments for retirement income. And income in retirement is often made out to be very complicated, but there are a few options that have time and time again assisted retirees, not only from a financial perspective, but also from a psychological perspective, as pulling from accounts in retirement it can be very daunting, especially if you're early in retirement and it's fairly new to begin to draw from your accounts. But before getting into the meat of today's topic, as always, let me give you an overview of my team and what we do for those that we work with. And I do want to mention that any tax strategies discussed should always be reviewed with the CPA or your tax advisor just to ensure that it fits within your unique situation. Now, back to us, we're a boutique wealth management and financial planning firm here in Irvine, California. However, we do have clients across the entire nation. And what we do with our clients, many of whom are on the line today, is we work with them on their holistic financial planning and investment management needs. We find that our industry is just a little too focused on just the investment side of planning. So we make it a priority to take both a comprehensive and holistic approach to planning, and then to continuously educate, which is one of the reasons why we host this webinar series along with our briefing series. But our process for planning involves building a well-designed financial plan, organizing our clients' investments in direct coordination with that plan, and then ensuring that any outside planning items have been handled. And that could involve our collaboration with other professionals like CPAs, attorneys, or really anyone within our client's advisory team. And here is a quick overview of our team. Within the firm, we have 7 planners, myself included, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's jump into today's topic. And as always, I like to bring back the topic that we're going to be discussing to what we call the pyramid of planning, shown here. And it essentially shows the areas within a proper holistic plan that should be accounted and planned for, especially as you navigate through retirement. And generally speaking, this type of planning is a bottom-up approach. And as you check off more of the boxes at the base of the pyramid, you can then begin to work on some of the areas higher up. And after today's conversation, hopefully you'll have a better understanding really of how to manage cash flow for retirement to allow yourself to have more time and less worry as you navigate through your golden years. So for our agenda, we're going to be reviewing 4 strategies for retirement income shown here. Now, these are not the only ways to create streams of income in retirement. However, they are 4 of the most popular that do require your investment portfolio, which is today's topic. So we'll discuss how you can raise cash and create income through the appreciation of your portfolio, through developing what we call an income generating portfolio, through a strategy called bond laddering, and then finally investing through an income-based annuity. And I'll tell you that there is no strategy that is better or worse than another. They're all just strategies. They all have varied pros and cons. So what I'm going to do today is really just educate you all on the specifics, and then hopefully you'll be properly informed to make an appropriate decision for your planning needs. So let's just jump right into it then with the first of the 4 strategies, the capital appreciation strategy. And this strategy is fairly easy to understand, and it's what many of my clients employ. And it essentially involves selling securities from your investment portfolio as needed to fund your lifestyle. So if you need $5,000 a month in retirement, you're just going to set a recurring distribution and sell stocks, bonds, mutual funds, or whatever investments you may have in your portfolio to raise cash. And I don't think we really need to go into too much detail on how this works, because like I said, it's fairly basic. But what I want to do is go through the concept through this graph. And essentially, whether your portfolio grows or declines due to the general market environment, you still are going to be selling out of positions to fund your lifestyle. whether we're in a bear or a bull market. Over time, though, one would hope that the investment value in their portfolio continues to grow and improve. However, that is where the main risk with this strategy lies. For example, if you're pulling too much from your portfolio, let's say you're withdrawing 10% yearly, but your portfolio's return is only 5%. Well, then your investment value, the amount that you actually have in your account, will probably decrease by about 5% per year until you've potentially exhausted all of your funds. On the other hand, you may be withdrawing a reasonable amount. However, if the market continues to underperform and your account drops in value, that could be affecting your principal value. And that's what we call the sequence of returns risk. And to explain this risk, I want you to take a look at these two charts. On the left side are two accumulating investors who at age 41 invest $100,000 into the market, and they do not touch their accounts until age 65. On the right side are those same two investors, now at 66 and retired, who begin to withdraw about 5% of their portfolio on a yearly basis. The difference on both charts are that investor A has very bad performance at the beginning of the time period, whereas investor B has fairly positive performance at the beginning of the time period. And then the opposite is true. Investor A has better performance at the end of the time period. Investor B has worse performance. If you can see this chart, if your screen's big enough, you can see the returns are actually flipped. They're the same return, they're just flipped. So at the end of the day, they both average about 8% yearly in both charts, because once again, the returns are just flipped. So what does this all mean then? Well, during the accumulation phase, the timing of your performance, it doesn't necessarily matter as much, because in this example, over a 25-year time period, they both ended up an 8% average rate of return, and they both had a balance of $684,848 at the end of the time period. But in the chart to the right, investor A runs out of money at age 82, and investor B passes away at age 90 with a $2.6 million portfolio. And that is due to the risk that I just explained on the last slide, the sequence of returns risk. So in summary, this is what people need to understand. Poor performance at the onset of retirement, when you begin to distribute from your portfolio, is a major risk that people do face with this strategy. And investors do need to be aware of it so they can prepare in the event that the markets take a turn for the worst. But one of the best ways to reduce this sequence of returns risk is to ultimately reduce your volatility, the ups and the downs within your portfolio's performance. And often, retirees do this just through diversification. And there's really no surefire way to reduce volatility completely. However, by reducing the general risk within your portfolio, often retirees find that the swings in their performance on a yearly basis can be reduced. Now, I always like to say that diversification never guarantees protection from losses. However, by investing in a well-diversified portfolio of equities, bonds, real estate, maybe even alternative assets, you essentially have more things within your portfolio that move different with different market conditions, resulting in a smoother rate of return in the long haul. And the best way to show this really is through a heat map of past performance. And what it shows, what this chart shows, is the performance of varied asset classes from 2008 to 2022, from the highest performing to the lowest performing. For example, if you can see this chart in 2008, the column all the way to the left, the highest performing asset class was bonds, returning 5.2%, and the lowest performing was mid-cap growth stocks within the US market at negative 44%. And if you take a step back now, and if you look at this chart, you can see that there's really no consistency within the returns. However, a diversified portfolio is generally middle of the pack. And as a retiree, this reduction in volatility can be very useful especially if you're constantly selling positions to fund your lifestyle, like the income strategy we're reviewing right now. Sure, maybe investing in an all equity US based portfolio may have the potential for higher returns in the long haul compared to a well diversified portfolio. However, there are never any guarantees. And if you have substantial volatility, then that could create some pretty significant issues later on in retirement, like I showed you with that sequence of returns graph on the slide before. So, to summarize this strategy, which is the capital appreciation strategy, one of the biggest risks is going to be your sequence of returns risk. But through diversification, you can work to potentially lower that risk. And many people do like this strategy because it allows you to maintain maintain the control of your assets and allows for the potential for growth within your portfolio throughout retirement. But as always, there are risks. So let's just move on to the second strategy, which is very similar to the first, which is essentially building a portfolio that has an income stream somewhat tied to it because of the investments that you position your money into. And this strategy is very similar to the last because you still maintain full control of your assets and you still invest in the stock and the bond market. But instead of selling out of positions to raise cash, you position your portfolio within those income generating securities. And what you do is you let your dividends and your interest accumulate as cash rather than just reinvest. So let me explain what this all means. There are a lot of investments that essentially distribute cash to the investors through either a dividend or an interest payment. Now, these that I'm showing you here are probably the four main types of investments, but there are others as well, and I'm going to quickly go over the logistics of each. First off, there are bonds. Bonds essentially represent a promise from the borrower to pay the lender, you, interest over a specified period of time, and then they pay your principal back at the end of the bond term. Now, the risks with bonds is that the company or the entity could default, resulting in you not receiving your payments or even your principal back. Now, dividend paying stocks are generally very established, publicly traded companies that are often very profitable. And instead of reinvesting the profits back into the business like a growth company, what they do is they pay their shareholders, potentially you, what is called a dividend, which is just a distribution of the company's earnings. Now, the risk here is that the board of directors decides if a dividend is going to be distributed. So while there are many companies that historically do pay dividends, they don't necessarily have to. It's never guaranteed. Additionally, it is ownership of equity, so you still have to deal with the market volatility or potentially the company going under, which would result in you losing all your money within that stock. And that brings me then to preferred stock, which is a type of stock that provides the investor a higher right to receive dividend payments. For example, preferred shareholders receive dividends before common stock shareholders. However, preferred shareholders do not have voting rights within the company. And then lastly, you can always invest directly in income generating mutual funds or ETFs, where essentially the fund manager invests into all of these types of investments and maybe even more that create income, or maybe invest into real estate holdings that create income. And then what happens is the fund itself pays you based off of the income generated. It's called a distribution of portfolio earnings. Now, this may all sound great, but with this strategy, there are risks as well. The first thing you should know really about all of these investments is that they all have investment related risk to them. Bonds, stocks, mutual funds, ETFs, they all can gain or lose value. So your portfolio still is going to have the potential to fluctuate, and it probably will fluctuate. Additionally, there are no guarantees when it comes to income generation. But with that all being said, let me show you a quick graph to kind of explain this in a little simpler manner. And this strategy may look like the graph I showed you a few slides ago, but the main difference here is that rather than you having to sell positions, like in the last strategy, cash potentially is just going to generate itself because you're positioned now within those specific securities that raise cash for you. And one thing to know is, generally speaking, this strategy may actually be a little more conservative than the approach that I shared within the first strategy. But what is important to know is that you could follow multiple strategies. You don't have to just pick one. For example, you could invest your portfolio into income generating positions and let those positions raise cash for you slowly, but maybe more cash is needed to pay for your day to day. So at month's end, you might still need to sell some positions to fund your lifestyle. So keep in mind as we review all these strategies that often retirees employ multiple. It's usually not just one. So that leads me to the next strategy, which is called the bond laddering strategy. And essentially, what a bond laddering strategy involves is buying multiple bonds using your available cash or your investment portfolio, and you buy them all at once. And each of these bonds you buy have different maturity dates. For example, maybe you buy a 1-year bond, a 2-year bond, and a 3-year bond, and so on until you've spread out your investment maturities enough. And the reason that you buy bonds of different durations, that's just how long lasting the bond is because the interest that bonds pay is generally correlated with the overall interest rate environment. And as you know, rates change. So that means that the interest newly issued bonds are paying will change compared to the bonds that you're holding. So ultimately, by spreading out your bond durations, you lock in various rates for various periods. And then whenever a bond matures and you are paid back your principal, you then go out and you buy a new bond. Now, this may not make complete sense, but let me illustrate it for you. And in this illustration, we use a 3-year ladder strategy. And you can see that in the first year, the investor bought a 1, 2, and 3-year term bond. The interest rates for those bonds in this example were 4, 4.25, and 4.5%. Now, after 1 year, bond A will come to term, and at that point, the investor would receive their principal and they would reinvest it then into a 3-year bond that is now paying different interest because I mentioned earlier, rates change, and so newly issued bonds will be paying different interest every year. After year 2, bond B matures, and then the investor reinvests. And then after year 3, bond C matures, and then the investor reinvests once again. Now, the overall benefit to this strategy is that you have somewhat, I call it predictable income over the course of your bond terms. The negatives, though, are that the interest rates change, and ultimately the rates that new bonds that you invest in will change. So you may have some years where you earn more interest than others. It's going to fluctuate. And like I mentioned before, bonds are not guaranteed or protected by insurance. So if a bond defaults, you may be out of the money that you invested into it. However, and then actually one last thing, if you sell a bond prematurely, it could lose or gain value. So as I mentioned, if you hold a bond to maturity, you just get your principal back. But dependent on where rates are at, you could always sell your bond and earn on the bond, or you could sell your bond at a discount. So just know that bonds do fluctuate in value, kind of similar to stocks fluctuate, unless, of course, you hold them to maturity. And lastly, and I am speaking in generalities here, because no one can predict performance, but generally bonds are more conservative than equities, at least looking back at past data. So in the long haul, this may be considered a fairly conservative strategy that could result in a lower rate of return than other strategies discussed. And that's why it's important to review with your planner, review with your CPA, determine what is best for your specific situation. But ultimately, this is what a hypothetical illustration may look like. If you hold your bonds to maturity, cash will slowly generate through interest, and your principal will always stay flat because every time a bond matures, you just get your initial investment back and then reinvest. Of course, once again, if the bond company defaults, then you might not get your money back. Now, one thing to mention with this strategy, though, is that you don't want to only own 3 bonds, like in the example in the previous slide. You'll want to potentially own dozens of bonds offering various interest rates from various entities, whether that be corporations, municipalities, or government entities. Just like with the stock market, excuse me, just like with the stock market, when you invest in bonds, you don't want to put all of your eggs into one basket due to default risk, which could leave you in a very unfortunate situation. So to be certain that you diversify your bond holdings, make sure you're investing in a broad range, or maybe follow a manager that does this for you. Or I'm sorry, invest with a manager that does this on your behalf. So you don't necessarily have to be managing it on a day-to-day basis. But with that, I'm going to talk to you about the last strategy, which is positioning your investments within annuities that have what I call an income rider associated with the annuity product. And I'm sure everyone has heard of an annuity before, and annuities are just a way to invest. It's just another investment vehicle. But when you use an annuity that has an income rider, essentially what you're doing is adding a benefit which allows you to potentially receive income for life from the insurance company. So let me explain. There are various types of annuities: indexed annuities, fixed annuities, variable annuities, and more. And the type of annuity you buy determines how your investments are actually going to be invested. But for the sake of today's conversation, the type of annuity isn't as important as the income rider. So let's just use variable annuities within our example for today. So with a variable annuity with an income rider, you would take your investments and you would invest them in some capacity within the annuity. Those investments may fluctuate both up and down in value. So the internal investments within your annuity, they actually act and behave very similar to other investment vehicles that you're used to. It's when you add on this rider that things change and are a little more unique. An income rider, what it does is it provides certain guarantees that are backed by the annuity company. So keep in mind that any guarantees are only guaranteed up to the good faith of that insurance company, as well as any financial backing from the insurance company. And every income rider on an annuity may look a little different, but what they allow is for the annuity company to provide you a certain level of income for either a predetermined or an infinite period of time. And the reason people often like these riders is because people are scared that they're going to run out of money in retirement. And the annuity rider helps to alleviate those concerns. Additionally, some products allow your benefit to increase each year through what's called a cost of living adjustment to essentially keep up with inflation. And other products may allow your income to increase if your internal investments perform well. Now, this all may seem very nice. I'm sure everyone likes guarantees, but there are some serious disadvantages to products like these and the riders associated with them. One of the largest, in my opinion, is that there is an additional cost for the income rider on top of whatever annuity fees there are. So often the total cost to invest is very, very expensive. Additionally, if you access your investments prior to, well, actually, let me rephrase that. If you access your investments early, you might be assessed what's called a surrender charge, which is basically a charge to get money out of the product. Or if you access your investments, it might lower the amount of money that you are getting paid on a yearly basis. And lastly, I want to mention once again that the guarantees are only as solid as the insurance company that is going to be backing it. So this is not like Social Security where the government's guaranteeing it. This is an insurance product, so make sure you're using a good insurance company. But with all that being said, though, they can be utilized very efficiently within an individual's financial plan if they have a very specific objective to take some risk off the table and receive income from their investments. And they can be very beneficial for those that are risk adverse because of those certain guarantees, along with the opportunity to still invest and participate in market growth. So let's just take a look at the final graph just to give you an idea of what this looks like. And summarized here, you can see that you consistently will receive income from the annuity company once you turn on your income rider. Your income potentially has the ability to increase if the investment value increases above what is called the guaranteed minimum benefit base. And then lastly, if your investment value hits zero, well, then often you will still receive income. But overall, annuities, they're not good or they're not bad. They're just another financial tool that can be used to solve a need. All four of these strategies that I've discussed have varied pros and cons associated to them. And ultimately, it's up to you and your advisor to determine what are the appropriate strategies available to you to ensure yourself setting yourself up properly for retirement success. So I hope these strategies made sense. What I'm going to do now is give you a handful of steps that you should take to help determine what is the best income plan for you as you navigate retirement. And then I'll close out with some final remarks. And if you've ever been on any of my webinars before, you'll know that I usually start the planning discussion with understanding and reviewing your goals and objectives. Your goals drive your planning. So depending on what you're trying to achieve within your dollars and your investment portfolio, well, that is going to affect your income plan. For example, an income plan for someone who is looking solely for retirement security is going to look completely different than someone who wants to pass on their assets most efficiently to their kids or their heirs. Secondly, you need to get organized and build out an appropriate balance sheet to see which assets you have and which assets you don't have, and see how they play into your long-term retirement planning, Social Security included. Next, review your expenses. Your expenses are what results in the need for income, obviously. So if you don't have a grasp on how much you're actually spending, then you're probably not going to plan the most efficiently. So get a grasp on your expenses, and that will help determine your distribution strategy. And the fourth step is imperative, and it is to project all of this outward. For example, project your assets into growth, project your Social Security or your pension, project your expenses and account for inflation, and then project your future required minimum distributions from your retirement accounts. This will essentially provide you with an idea of how much income you actually need given other income sources, and it will help you as you build out an appropriate income plan. And as always, you want to review and adjust anytime life changes, or review anytime there's any major change in your life, or if you just feel like something substantial has happened to your financial situation and you need to update and review. Now I want to show you, this is what modeling looks like. It's very simplified in this example, but it's not too complex. It's a very detailed Excel sheet, essentially, projecting everything out, and it's important. And what I want everyone on this call to understand are projections are just to show you how things currently look. The projections are not your plan, but once you complete your projections, then you can use the information that you've learned and that you've derived from the modeling to make those informed decisions on how to handle your income. For example, I've encountered many people who stress about retirement and feel as if they don't have enough money to live off of. So they immediately want to buy an income annuity to protect themselves from living a long, healthy life and outliving their portfolio. But after reviewing the modeling, they realize that they're actually in a much better situation than they thought they were, and then they decide on a different income strategy that may be a little more effective. Essentially, to make an educated decision, you need to do the work and the planning in advance to come to a proper conclusion. So, if you want to talk, feel free to reach out. For the clients on the line, just know our offices are always open. Don't wait for us to reach out to you. Reach out to us if you want to talk. And for those that aren't clients, I'll tell you that if you're looking to build a retirement income plan, if you're not currently working with an advisor, or you just have some questions, reach out to me, reach out to someone on my team. We'd be happy to talk. But I'm going to close out there and open it up to Q&A. And I am going to close out the recording now before the Q&A. So if you're watching the pre-recorded version, feel free to reach out to me directly. Have a great day, and let me just close this real quick.